All right, let's jump right into this explainer. I want you to imagine the global economy, not just as a normal marketplace where we buy and sell stuff, but as a giant, high-stakes game of predict the future. Because literally everyone, from a local wheat farmer to a major airline CEO to a Wall Street banker, is constantly trying to protect themselves against one simple, unavoidable fact. Absolutely no one knows what prices are going to do tomorrow. Today, we're diving deep into the massive and frankly fascinating financial machinery that was built to manage that exact uncertainty. Now, to really understand the scale of this, you have to wrap your head around this number, between $600 and $700 trillion. That represents the total notional value of the global over-the-counter derivatives market. Just let that sink in for a second. We're talking about a hidden financial system that is roughly 10 times larger than the entire actual global economy of physical products and services combined. It is an absolute behemoth. And yet, it operates almost entirely behind the scenes. And, there's a huge misconception here. When most people hear the word derivatives, they instantly picture these wild, speculative gambles on stock prices. But the vast majority of this market, like 75% of it, is actually dedicated to interest rate derivatives. The rest is mostly foreign exchange and commodities. So this isn't a giant casino for the stock market. It's actually a massive utility for global corporations and banks to protect themselves against the unpredictable swings of interest rates and currency values. Section 1. Handshakes to high-tech stadiums. Let's trace exactly how these markets evolved from simple agreements to complex global systems. Okay, so it all starts with the foundation of commerce, which is the spot market. If you walk into a village square right now, hand a guy $1, and walk away with an apple, that's a spot market transaction. It's immediate. It's delivery versus payment. Simple, right? But it leaves you totally exposed. Think about it. What if you run a bakery, you need apples every single day, and suddenly a massive shortage causes the price of apples to triple next month? The spot market offers absolutely zero protection against that. So to lock in those future prices, businesses originally started using forward contracts. Picture a farmer and a baker meeting up in private, shaking hands and agreeing, hey, I'll buy your wheat in 6 months for exactly $5 a bushel. It's great because it's custom negotiated. But it carries this immense counterparty risk, which is just a fancy way of saying, what if the crop fails and the farmer just skips town? To fix that, the market evolved into exchange-traded futures. Instead of a shady private handshake, these trades happen in a highly regulated, standardized stadium, like the Chicago Mercantile Exchange, which pretty much eliminates the risk of someone breaking their promise. And here is where the real magic of that organized futures market happens, the clearinghouse. Think of the clearinghouse as the ultimate, undefeated referee. If our farmer and baker trade wheat futures, they actually aren't even trading directly with each other anymore. The clearinghouse steps right into the middle, becoming the buyer to the farmer and the seller to the baker. It's a central intermediary that absolutely guarantees the deal goes through, shielding you entirely even if your original trading partner goes totally bankrupt. Plus, you weren't waiting a full 6 months to see who actually won or lost the bet. Futures use a strict daily scorecard called marking to market. Every single afternoon, the referee checks the closing price. If the market moved against you, the clearinghouse literally sweeps cash out of your margin account and hands it straight to the winner. And if your account drops too low, boom, you get a margin call and have to deposit more funds immediately. You're settling the score every single day. Section 2. Welcome to the Maybe Club. Let's see how this whole concept shifts for people who want a bit of flexibility instead of those rigid commitments. Enter the world of options. An option is, well, exactly what it sounds like. By paying a small upfront fee, which we call a premium, you're basically buying a magic ticket that gives you a choice. You get the right, but crucially, not the obligation, to buy or sell an asset at a locked-in price. So if the market moves in your favor, you play your ticket and cash in. But if it moves against you, no problem. You just walk away. You throw the ticket in the trash, and the absolute worst thing that happens is you lose that initial fee. Now, these come in two main flavors, calls and puts. A call option is a bet that prices are going to skyrocket. It gives you the right to buy at today's locked-in price, even if the actual price goes up 300% tomorrow. A put option is the exact opposite, a bet that prices will plummet, letting you sell high even in the middle of a market crash. And the beauty here, the ultimate safety net for options, is that whether you buy a call or a put, your maximum possible loss is strictly capped at whatever you paid for that initial premium. You're probably wondering, how on earth do they decide what that magic ticket should cost? Well, that exact premium is calculated using the famous Black-Scholes model. It's a complex formula, but it really just boils down to 5 mathematical factors: the current spot price, the strike price you want to lock in, the time left on the clock until expiration, the risk-free interest rate, and honestly, the most important one, price volatility. Because let's face it, the wilder and more unpredictable the market, the more expensive that option is going to be. Section 3. Trading payments and fire insurance. Now we are stepping up into the big leagues, where massive financial institutions are trading interest rates and buying corporate safety nets. Let's picture an interest rate swap in action. Say Bank A has a loan with a floating interest rate that bounces around every month, but they really want the safety of a fixed rate. Meanwhile, Bank B has a fixed rate loan, but they want to gamble on floating rates. Well, instead of tearing up their original loans, they just agree to trade their payment streams. Bank A pays Bank B a fixed amount, Bank B pays Bank A a floating amount. They just casually swap their risk profiles without ever having to touch the underlying loans. It's incredibly efficient. Then, in another corner of the swaps market, you have the credit default swap, or CDS. A CDS works exactly like a fire insurance policy, but for a corporate bond. A bank pays a steady premium to a seller. In exchange, if the underlying company happens to go bankrupt, if the house catches fire, so to speak, the seller steps in and pays out a massive lump sum to make the bank whole. Section 4, the 2008 crash and risks. Which brings us to a frankly terrifying question. What happens when the entire neighborhood catches fire at the exact same time, and those insurance companies can't afford the payouts? We saw this violently exposed during the 2008 financial crisis. The derivatives market was plagued by 4 hidden dangers. Extreme leverage meant even a tiny drop in prices caused catastrophic, cascading losses. When the panic hit, sudden liquidity risk meant the market completely froze. No one could close out their positions. And because everything was tangled up in private off-balance sheet handshakes, counterparty default risk triggered massive systemic contagion. One failing bank literally dragged dozens of others down with it. And that leads us to what is easily the most important takeaway of this entire explainer. Derivatives do not eliminate risk. They just transfer it. They don't make danger magically disappear from the global economy. All they do is pass the bag to someone else. And if the person holding the bag at the very end of the line isn't strong enough to carry it, well, the whole system collapses. Section 5. Fastening the safety belts. After that historic crash, global regulators realized they absolutely had to step in and police this betting world. So we saw a massive regulatory shift. For decades prior to 2008, the OTC swap markets were essentially the Wild West, largely unregulated private handshakes. But following the collapse, we got landmark rules. Dodd-Frank in the US, MEIR in Europe. Their main goal? To force all those dark private bets out into the brightly lit stadium we talked about earlier. They mandated central clearinghouses and incredibly strict trade reporting, all to make sure the system stays stable. As an impartial observer, it's pretty clear this creates a fundamental trade-off. Pre-regulation, institutions had total flexibility. They could heavily customize their risk management, but it came with terrifyingly high systemic risk. Today, post-regulation, the financial system is dramatically safer and way more transparent thanks to standardized contracts. But on the flip side, banks now face massive compliance costs and definitely have less flexibility to tailor their hedges. So, as we wrap up looking at the sprawling $700 trillion mechanism, you really have to ask yourself a profound question. Is this global derivative system the ultimate safety net, an incredible tool that allows businesses to thrive by efficiently managing their risks? Or, when you mix it with high leverage and human nature, is it just a ticking time bomb? It's a fascinating balance, and honestly, understanding it is the key to understanding the entire modern global economy.